In this episode, I interview Bob Lai, who is the blogger behind the popular website talkand.com. Bob and his wife started building a dividend portfolio in 2011. Today, their portfolio generates over $43,000 in dividends each year. And they did this on a single income with two kids while living in one of the most expensive cities in the world, Vancouver. Hi, my name is Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. Let's get started with my wide-ranging interview with Bob. Bob, welcome to the Simply Investing Dividend Podcast.
Thanks for having me on, Kanwal.
Awesome. Great to have you today. We're going to have a great discussion around dividend investing. So why don't we start with the beginning? What got you started? When did you start dividend investing, and what got you into taking that approach when it comes to investing?
Yeah, so I kind of started call it investing when I was pretty early on, like during university was bought a few individual stocks per my dad's recommendation, but I didn't really know what I was doing. And then after graduating from university and started working, I, the usual investing in GICs and mutual funds and then some individual stocks, but it was like a mixed bag of everything. The first time I got into dividend stocks was probably just before the financial crisis, circa 2008. The first dividend stock that I purchased was called ING, which back in the days I thought it was the ING Bank, but it turns out it wasn't. It was the insurance branch of it. Which eventually renamed itself into Intact Financial. So that was the first stock I bought, dividend stock I bought in 2008, and that was it was an interesting experience because basically a year after or a few months after the financial crisis hit, and that stock went down, I don't know, 30, 40, 50%. But when I look back, when at the time I was like, well, I could sell it and take the loss, and put it in GICs. But by then, when the financial crisis hit, the GIC rate went from like 3% down to 2 or 1.5%. Whereas with the ING stock, it was because of yields. It was yielding cost on yield. I know that's not a great matrix, but from my point of view, the cost on yield was around 3%. And so for me, it was roughly the same amount of money I would get if I were to sell it and then put it in GIC. So I decided not to sell, right? And then similarly got into Manulife Life as well, again, right before the financial crisis. So held on both of those. And then when we really got into serious about dividend investing was around 2010, 2011, started reading more books. And then, really got serious into dividend investing. So that's when we moved quite a bit of savings into, dividend stocks. That's basically how we started. So yeah, I would say we got serious around 2010, 2011. But before then, we kind of held a few stocks sort of randomly, didn't know what I was doing kind of thing. Yeah.
Mm-hmm. Yeah, that's great. Thank you for sharing your story. It's similar to mine, right? For when I got out of university, got my first day job, my parents said, well, why don't you go buy some mutual funds? You want to save for your future. So mutual funds was the way to go for me. And then you mentioned GIC. So for our American listeners, those are term deposits, right? You put the money in for a fixed period of time, guaranteed you're going to get your money back, but the interest rates weren't that great anyway. And you mentioned, when you compared the interest rate on the GIC versus what you were getting with ING, just the dividend yield was pretty good.
Mm-hmm.
Yeah.
Yeah.
So This is on your website, so this is nothing new. So I'm going to read this off, and then I'll ask you a question regarding this. So on your website, it says you're living in one of the most expensive cities in the world, Vancouver, which is a beautiful city, by the way. And then it says, as a single income family with 2 kids, you're able to build a dividend portfolio and generate over $3,600 a month in dividends, which is incredible. That's why I wanted to have you on the podcast here. That's an incredible story. So a couple of questions immediately as people see that on your website, and we'll put it down in the link in our description below so everybody can check out your website. How did you do that? How did you, on a single income, most expensive city in Canada, probably in the world, one of the most expensive cities, how did you achieve that kind of growth in building your portfolio?
I think just we've been very fortunate, right? So I mean, call it a bit privileged. Like I didn't my parents paid for my university education, so I didn't come out of university with a student debt, right? So I was very, very fortunate, very grateful for that. My wife's from Denmark, so in Denmark you could go through post-secondary for free, actually, and the government actually pays you to go to post-secondary. Now, she did do her master's, so she did take out a student loan, and when we got together, we paid it off basically right away. It wasn't a big amount of money. I mean, I think really what contribute to our call it success of dividend investing so far is our relatively high savings rate. We've been able to keep our expenses relatively low, and then that allows us to save quite a bit of money. Now, even though I said single income family, what we're doing is, like, my wife is doing some side hustles, and she actually a couple of years ago started her own doula service. So she's now generating some money, but what we're doing is we're basically living off the income from my job, and then everything else we kind of put aside as savings, right? So you can imagine we're basically living off my full-time income, and then everything else from our side hustles and other stuff are saved up for investing purposes. So that basically allows us to save money and invest quite significantly each year. So that has helped us, right? And as our dividend income, we also reinvest 100% of our dividend income. So as that income grows, we get more. We're able to invest each year. So that helps kind of the compounding effect, right?
Yeah, absolutely. And that's, you're 100% right. The more you're reinvesting the dividends, the more dividends you're going to get next year and the year after that and the year after that. It just keeps growing, right? The compounding effect, like you mentioned. So your story is inspiring because this is incredible, right? Like, I'm sure you've looked at other bloggers out there who are in the personal finance space, and a lot of them will go to countries like Thailand or India and just live there because they're going to bring their costs down. And there's nothing wrong with that. But what I'm saying is your story is inspiring because you're here in Canada. I'm in Canada as well. I'm in Ottawa. And to see someone else achieving financial independence and getting to that spot is incredible. And you mentioned on your website, you're looking to gain financial independence by 2025. Are you still on track?
Yeah. So, I mean, last year we got we got about 42,000, a little bit over 42,000 in dividend income, and I think that cover our core expenses by, I think, 100 something percent, over 100%, right?
Nice.
So that helps quite a bit. So from a core expenses point of view, our dividend income could cover our core expenses. So core expenses meaning, like groceries, insurance, life insurance, household items, utilities, gas, health-related expenses, etc. So what core expenses don't include are like, dining out, vacation, entertainment, charitable donations, things that's called non-essentials, right? So the goal by 2025 is to have enough dividend income to cover our total expenses. And I think we're very well on track of that. Even if we're not, and when I wrote 2025 on the blog, it was just kind of like a random day we picked far out in the future. We're not very set on the date because I'm still enjoying my job and we're enjoying what we're doing. If we happen to have enough dividend income by 2025, it doesn't mean I'll just quit my job. It just gives us more flexibility, right? So right now we're on track. Furthermore, we don't see us ever just stop working completely and not make any money. So even if I do decide to, quit my full-time job, I'll probably still work in some function, probably part-time or something. And my wife has her doula service, as I mentioned, which she's enjoying quite a bit. So we'll probably do we'll continue generating some sort of income. So really, with the dividend income and some side income supplementary, that will be enough for us, right? So yes, to answer your question, I think we're still on track for 2025.
Yeah, that's great. And I just want to reiterate the point that you mentioned before about keeping expenses low, right? In everything we talk about in the personal finance space, you want to spend less than you earn, right? If you're doing it the other way around, then forget about any of the stuff we're talking about today. For any of our audience listeners, right? You want to spend less than you earn. And so you want to keep your expenses low. And then what we're talking about today is dividend investing, taking that extra surplus money, investing it in a way that it continues to grow year after year, right? So, and you're doing that right now, which is great.
Yeah, and just to add, I mean, there's a ration of people in the personal finance space is all about penny pinching and save as much as you can and live as cheaply as you can. I think that's quite contrary. I was certainly there in terms of save every penny, but over time I have find my balance, I think, a little bit, in the sense that you can't just save every little penny and really deprive yourself. You kind of have to enjoy your life today as well. So it's about finding that personal balance between saving money for the future and also spending some money to enjoy for the present moment. Furthermore, I think there's also a really big focus on cutting expenses, but there's only so much you could cut before you deprive yourself, right? So the other side of the coin is you could look at how to increase your income, right? Because income, I would call it, there's no ceiling on how much income you can make in theory, right? Whereas expenses, there's definitely a limit where you can't cut anymore, right? So it's about widening that savings and earning gap. So as you widen that gap, that gives you more money to invest on your dividend stocks.
Yeah, absolutely. And then at the end of the day, the investments and the dividends that are coming in, the more you have, the more flexibility it gives you. Then you can decide when you want to quit your day job, or if you love your day job, you keep doing it, right? Mm-hmm. It gives you flexibility, gives you options and freedom at the end of the day.
Yeah, I think it all comes down to having more options, right? So when you have your dividend portfolio generating a certain amount of money per month or per year, you're no longer tied to your job or your prime source of income, right? So maybe you feel more at ease, in terms of how much money you're generating. You're not too worried about whether you may, if there's a layoff, you're not as worried because you have another source of income, right? So again, it gives you more options in life.
Yep, absolutely. And so I mean, my goal with the podcast here is to inspire and motivate everyone that this is possible. And by having you on as a guest today, this is showing other people that this is absolutely possible, right? It's not something that's, you have to be super rich to be able to start with dividend investing and buying stocks. Now, if you don't mind me asking, and I'm happy to skip this question, but again, based on what we talked about earlier about, your sort of bio that's on your website, and you mentioned yourself, you're at 40,000, 42,000 a year in dividends income. Are you a brain surgeon? Are you making like $600,000 a year? What's your day job?
No, so my day job, I work in high tech sector. No, we don't. We don't make like 600K for sure. I mean, we live, I would say, average, maybe a little bit on the higher end average, but nothing. It's not like 250K. I mean, no, like way less than that, right? So
yeah,
it again comes down to your savings rate and really what you prioritize in terms of what you spend on that saving each month, right? So for the most part, we try to invest as much as we can each month, and regardless what the market is doing. So when we have the money, we try to be fully invested and just kind of leave that psychological part out of it. So it's like, say we have $1,000, we buy one stock, and then we maybe another month we saved up another 1,000, we buy another stock, instead of thinking, oh, the market is down, oh, maybe I'll wait a few days, or oh, the market's up, I'll wait for a few days. Just like basically identify a few stocks that might be interested, and then when we have the money, we just kind of move it into our broker account, and then just narrow down, if it's like between Royal Bank, call it 3 stocks, right? So it's maybe Royal Bank and I don't know, Enbridge and Fortis that IP monitor, and then just kind of say we have $1,000, just say, okay, maybe it's time to buy Fortis because it's a little bit underweight in our portfolio. So kind of get as much psychology out of investing as we can, and just be level-headed. I think that's the key.
Yeah, no, that's great. And I've got a couple of questions where I want to dig deeper into how are you selecting stocks? How do you decide when to buy? How long do you hold? All of those questions, I want to get to those. But first, I just want to finish off on this. Your story is very inspiring, and you had another story on your blog, and I'm going to link to it down below in our description. I want everybody to go check it out. And so I want to go to there first. And this is an incredible story. This is one of your readers, and you referred to him as Reader B. A fellow Canadian shared his amazing dividend investing story. Him and his wife retired in 2004 at the age of 55, have been living off of their dividends ever since. Now, this is where it gets crazy. They're generating $30,000 a month in dividend income. So that translates to $360,000 a year in dividends.
Yeah.
That is incredible.
Yeah.
Now, again, now you talked to them, right? So you had that, you got the whole interview on your blog.
Yeah.
Are they both brain surgeons making $800,000 a year?
No. It's kind of a funny story because Reader B reached out to me. This was probably, I don't know, 2-3 years ago. Maybe, I think that was maybe before COVID. And he was like, "Oh, I just want to let you know that you're on the right track. You're in your late 30s and you're already generating income. And, if you keep this up, you're going to get to where I am today." And we started exchanging emails, really, really long emails and very detailed. And my mind was just blown when he started sharing his numbers. And I was like, wow, first of all, I really appreciate he reaching out to me saying that I'm on the right track and, all that sort of things. And then the more we exchange emails, I was like, this is like gold. I need to share this with my reader. So it took me probably like a month worth of email back and forth to finally convince him to do this interview and that was the result of it, right? And it actually took a while to come up with this interview, and we did a lot of editing because he didn't want to share his identity, and but he had obviously a wealth of knowledge to share with the readers. So we try to sort of massage the questions and the answer to make sure he stays hidden with his identity, right? At the same time, he was like sharing like his portfolio with me, and it was just like my mind was blown again. Like, and then in fact, once we published that article, a few months later, he was like, "Oh yeah, when my dividend went up, I think it was like 400K or something crazy."
Wow, that's incredible.
But yeah, but he was saying, I mean, he was, even though we talk about like tax optimization and stuff in his art, he fully admitted he wasn't very tax efficient for the most part, right? So obviously there are things that we all learn as we go through our investing career. So it was really interesting talking to him and exchanging ideas and stuff. So it was an awesome interview, and I think a lot of people enjoy that piece.
Absolutely, I loved it. I immediately shared it with my audience, and I got a lot of great feedback. But somebody wrote back and said, "Well, reader B and his wife probably had a couple of $1 million sitting around, and that's how they started their portfolio." Is that the case?
No, they were very similar to us. Like they save, and one thing they don't have is they don't have any kids. So a lot of readers, well, they don't have kids, therefore they could save a lot of money. But I mean, kids are as expensive you want them to be, right? Kids could be relatively, they don't have to cost a lot of money, right? Like there are ways to save money despite having kids. So I don't think that's the main reason. I think the main reason is they're very conscious about how they spend their money and how they invest, and that portfolio built over time, right? It wasn't like a couple of years. It took them decades to build that size of the portfolio.
Yeah, and you mentioned in your article as well, you said that their salary, I mean, converted to today's money, was approximately $110,000 for the husband, and his wife was about $90K. So that's not an outrageous salary. It's $200K. It's obviously for some Canadians, it's on the upper end of the echelon. Yes.
But if you have two couples working full time, I mean, it's not outrageous, right?
Yeah, and even if you could achieve half of what their success has been, or less than half, you're looking at $150,000 a year in dividends.
That's still pretty awesome, right? And the key here is dividend income is pretty tax efficient in Canada. Yeah. So, I mean, you mentioned in the article, and people could look it up. You could actually get tax-free dividend income up to, I think now it's maybe 55K, 60K a year per person. Yep. So that means if you split your dividend income between you and your spouse, assuming you have a spouse, you could essentially get anywhere from 100 to 120K a year tax free, assuming you're not working or generating income elsewhere, right? So that's pretty powerful. If you're working full time, you're getting 120K or 100K, you're paying quite a bit of taxes, right?
Yeah, like 40% of that is going to go to taxes.
Exactly. So it's very dividend income. That's where dividend income is pretty powerful. It's very tax efficient that way.
Yeah, extremely powerful. I looked it up last month, and for folks living in BC, it's $65,000 a year, and you would pay $65,000 in Canadian dividends, and you would pay zero in income tax. So like you said, if you add that with a spouse or a partner, that's $130,000 a year in Canadian dividends, and you would pay no tax on that. And I just want to let the audience know, this is outside of your RRSP and outside of your TFSA. And for those in the US, it's similar numbers. They're different, but there's around the same ballpark. Even in the US, outside of your 401k and outside of your IRA or Roth plan, the IRS has taxes U.S. dividends extremely favorably. And
Yeah.
in Canada, it's the CRA does the same thing with Canadian dividends as well.
Yeah, and just one thing to keep in mind is we're talking about eligible dividends, right? So
Yes.
those are meaning corporation dividends that corporation pay out. If you invest in like partnership and REITs, that's a little bit different. Those are they don't have as preferential dividend tax treatments.
Yeah, absolutely. That's good to know. Okay, so now we're going to get into how do you decide which dividend stock you're going to invest in? Do you have a criteria? Do you have a checklist? How do you decide which company you're going to invest in?
Yeah, I mean, it really comes down. It's actually pretty straightforward, to be honest. And I've written a few articles on my blog, but it really comes down to, what do you use on a daily basis, right? I think I had an article called "Be an Owner." It's essentially owning companies that you use their products on a daily basis, right? So, banks, utility company, telecommunication, grocery stores, things like that. That kind of give you some idea in terms of the names. Another thing that I like to do is to look at these ETFs and see what they hold for the top 10, top 15 companies, right? And most of these companies probably pay dividends, right? At least on the Canadian side, even the US side, right? Like Apple, Microsoft, obviously not Amazon, and not
Facebook or
not
Tesla.
Facebook or Tesla, but you could narrow down pretty quickly, right?
Mm-hmm.
So once you get those names, you could do some more research, right? So there you could look at what's their dividend history, what's their dividend payout ratio, their dividend raise history, and dividend growth rate over the years, and that helps you to further narrow down your selections, right? But again, going back to my original topic, is that you want to own things that you use on a regular basis, and things that you're familiar with, right? So, take banks, right? Like we bank at TD, so we own TD because I know how that bank operates relatively as a customer, and don't really like dealing with banks because what do? They take your money, hold it, and then they loan it out to other people and make money, and then they pay you very poor interest, right?
Yeah.
And they also charge you monthly fees for holding your money, which is kind of odd, or requires a minimum balance. So from that point of view, the business model makes a lot of sense. And furthermore, I don't know that many people change their banks on a regular basis. So it's from a customer point of view, it's a very stable customer base, right? So I like banks. Another name, say Enbridge. In North America, we depend on natural gas and oil, right? We most of us use natural gas for heating our houses. What does Enbridge do? They transport these natural gas and crude oil across North America. So we rely on those, right? And if you look at in recent years, it's becoming increasingly more difficult to build new pipelines because of environmental concerns. So what does that mean? That means the existing pipeline for Enbridge are more valuable than ever, right? So kind of makes sense. And if you look at the pipeline sector, a lot of the smaller pipeline companies are getting bought by these bigger ones, right? So yeah, it's really identify companies that you're familiar with and that you use on a daily basis, and then start diving into the numbers, right? You could look at P ratio, you could look at the historical P ratio, historical yield to see where the evaluation is in terms of the stock price. You could look at like I said, the dividends increase streak, dividend payout ratio, dividend growth rate. Another thing I like to look at is PEG ratio, That's a P divided by estimated growth. So the lower the PEG ratio, the better, because that means the company will grow significantly. Yeah, it's pretty simple actually. Just think as an owner, do you really want to own this business, right? Is like, for example, if you get on the public transportation, look around. What do people use on their phone? Like for phones, do they use Android? Do they use iPhone? Like that kind of could tell you, does it make sense to invest in Apple, for example, right?
Yeah, no, that's a great explanation. It's you're almost, and correct me if I'm wrong. It sounds like you're almost, when you're talking about banks, Enbridge, I would even put the food retailers, right? Like the big giant food retailers. We're almost talking about companies that are recession proof. Like if whether you have a job or you're laid off, you still have to heat your home. Like when you get home and it's the middle of winter, you need to heat the home, and you still need to eat. And so those products and services are generally always in demand. And
yeah, I mean that's the way to consider, right? Recession proof. Now, obviously, like banks and some businesses will get impacted by if there's a recession. But that's the nature of the economy, right? But I mean, if you look at the Canadian banks, they've been paying dividends since the late 1800s, right? Uninterrupted, right? That's
impressive.
That's over 200 years, right?
Yeah.
And that's sure, they don't increase dividends every single year, but a 200 year dividend paying streak, that's pretty impressive, as you said just now.
Yeah.
Like telecom, like in Canada, we're paying probably one of the highest data rates in the world. So why not invest in telecoms, right? The Caldas, the Rogers, the Bell of the world, right? Even in the U.S., I think AT&T and Verizon, they have their own challenges, but if you buy in at a right price, I think it makes sense for long term. So yeah, it's just buying companies that make products that you use on a regular basis, and the key is, the harder for you to switch the product, the better, right? As a shareholder,
that's right. Absolutely.
Like I personally like Apple a lot, because I personally know a lot of people that had an iPhone, switched to Android, and then a few months later switched back to iPhone again, because one, they're deeply tied into the ecosystem, and two, maybe their families and friends are using iPhone, so they want to use iMessage to chat with their family and friends, and that kind of forced them back to iPhone. So when company have that strong pull, that's actually really good as a shareholder.
Yeah, absolutely. Customer retention, right, is key. And so somebody like Apple, absolutely, they have that. Now, so Bob, if you look at today's economic climate now, Bank of Canada recently increased the rates again. And in the U.S., same thing with the Federal Reserve. Last year, we saw a number of increases. Inflation still high. I believe the last numbers to come out were still a little over 6%. Everybody, everywhere you read, they're calling for, either we're in a recession right now or we're going to be in a recession this year. Does any of that stuff scare you? Are you changing the way you invest this year? Stay tuned next week for Bob's answer to my question. In part 2, we continue our discussion, and Bob talks about his reaction to his portfolio dropping in value by $250,000 a few years ago. So stay tuned next week for part 2 of my wide-ranging interview with Bob.